All right, let's jump into the world of mutual funds. You ready to see what's been happening in the market?
Absolutely. Always fascinating to see how things are shaking out.
Well, we're diving deep into the mutual fund industry update from Geojit Insights. This report covers February 2025, so it's like a snapshot of what's driving investment decisions right now.
Yeah, and February was a pretty eventful month, that's for sure. Some real head scratchers in there.
Okay, so let's paint a picture of what was happening. Indian equities, they had a bit of a rough go, continued on a downward trend.
They did.
And what makes this so interesting, it's the 5th consecutive month of decline. Like, we haven't seen that in almost 3 decades.
Yeah, you got to go all the way back to 1996 to see something similar. It's pretty remarkable, actually. Think about it. That's the year the Nifty Y50 was launched, and it's the last time it fell for 5 months straight.
Really makes you wonder, doesn't it? Like, is this a sign of something bigger, a shift in the tides?
It certainly prompts some reflection.
Right. And it wasn't just the Nifty Y50 feeling the heat. The Nifty Next 50, the Mid-Cap 150, Small Cap 250, even the Micro Cap 250, they all took a hit. Some even steeper than the Nifty Y50.
Yeah, that's the thing about these broader market trends. They can really ripple through different segments.
Yeah. Like imagine if you had, say, 1 lakh rupees invested in the Small Cap 250 back at the start of this 5-month slide.
Oof, yeah.
That could be worth significantly less today.
That's a good illustration. It really hits home how these trends can impact your investments. Something to keep in mind for sure.
Definitely. But hey, it wasn't all doom and gloom in February. Gold had a stellar month, gained almost 3%, and it's getting pretty close to its all-time high.
Yeah, gold's been shining lately.
Meanwhile, silver just kind of, hung out. Didn't really do much.
Yeah, pretty flat. Makes sense though, right? When the stock market gets a little rocky, investors tend to flock to safe haven assets. Gold being the classic example, it's that flight to safety instinct kicking in.
Yeah, makes sense. But here's something else to chew on. The rupee. It weakened against the dollar. Crossed that 87 mark. Not great news if you're planning a trip abroad anytime soon.
Yep. Or for businesses relying on imports for that matter.
True.
A weaker rupee means those imports get pricier. Could even have a knock-on effect on inflation. It's all interconnected.
It's all connected. Okay, so we've got this volatility, some clear winners, some not-so-winners. How did this impact the mutual fund industry as a whole? Because despite all this market shakiness, the industry still pulled in over 40,000 crore rupees in net inflows in February.
It did. That's right. But, and there's always a but, that number is actually down 28% from the 3-month average.
Interesting.
So the money's still flowing in, but the pace has definitely slowed down.
So even though the industry is still growing, it's like investors are maybe tapping the brakes a little bit.
Exactly. Proceeding with a bit more caution.
A little more caution, yeah.
Yeah.
And when we look closer at the types of funds that are seeing inflows and outflows, it paints an even more interesting picture of what's going on in investors' minds. Like open-ended equity, hybrid, solution, and other categories, those all had net inflows, along with close-end debt schemes. But on the flip side, open-ended debt and closed-ended equity funds, they saw money flowing out.
Yeah, that's a key observation. It's not just about the overall investment, but how it's moving.
Yeah.
And that shift, that's the story. It seems to be about changing preferences and risk appetite, how comfortable people are with different levels of risk.
Yeah. All right, let's zoom in on equity funds specifically. It sounds like that's where some of the biggest changes in sentiment are happening. Inflows slowed down to 29,242 crore rupees, which is almost a 25% drop from the 3-month average.
It is quite a drop.
And actually, February 2025 had the 10th lowest inflow rank for equity funds in over 5 years.
Wow, that's significant. Definitely signals a shift.
Seems like investors are getting more cautious about their equity exposure, especially with all this recent volatility in the market.
Yeah, understandable. But here's what I find interesting. Even with this overall slowdown, some specific equity categories are booming. Like sector thematic funds, those are still attracting a ton of investment, even though they saw a pretty big drop from their 3-month average.
Right. Suggests investors are being more selective. It's not just about broad equity exposure anymore. They're looking for targeted opportunities like renewable energy, artificial intelligence, those kinds of things. It's like they're saying, okay, the market may be a little uncertain right now, but I'm still betting on the future of this specific sector.
Yeah, they're picking their spots.
Exactly.
And it's not just sector thematic funds. Flexicap and small cap funds, they also saw significant inflows in February.
What's fascinating about that is those categories, especially small caps, they're known for being more volatile. The fact that people are pouring money into them, it suggests a willingness to take on more risk. They're looking for potentially higher returns, even if it means a bumpier ride.
Yeah, it's that classic risk-reward trade-off. They're betting on specific pockets of the market that they think have the potential to outperform.
High risk, high reward. So it's a mixed bag of emotions going on with equity funds, right? On one hand, maybe overall sentiment is cooling a bit, but on the other, there's still a lot of excitement and targeted investment happening.
Absolutely. It's a dynamic landscape. Understanding these nuances, that's key to navigating the market effectively.
Okay, let's switch gears a bit now and talk about debt funds. They seem to be experiencing their own ways of change. Remember how we mentioned earlier that open-ended debt funds were seeing net outflows? Well, in February, debt funds as a whole recorded a net outflow of 6,477 crore rupees. That's a pretty big shift because it breaks from the previous trend of inflows.
It does, and it might be tied to the rise in 10-year benchmark GSEC yields we saw in February. Remember, those spiked to 6.83%,
Oh,
which makes government bonds more attractive. Investors might be pulling out of debt funds to invest directly in those higher-yielding bonds.
so it's not that they're shunning debt altogether. It's more about being more selective, more strategic about where they're putting their money within the debt market.
Exactly. They're looking for the best opportunities. And we see this selectivity reflected in how different debt fund categories performed. Some, like liquid funds, corporate bond funds, and short duration funds, those saw inflows.
Right.
But others, like ultra short duration, money market, and low duration funds, those face significant outflows.
So why would investors favor some debt categories over others? It seems like there's more to it than meets the eye.
There is. You have to think about investor psychology. How are they reacting to current economic conditions? For example, those inflows into liquid funds, those could be driven by investors seeking safety and liquidity amidst all this market uncertainty. They're parking their money in those low-risk funds, waiting to see how things play out.
Makes sense. Kind of like hitting the pause button.
Exactly. But then you have corporate bond funds. Those are a bit riskier than liquid funds.
They are.
So those inflows, those could suggest some investors are actually feeling optimistic about the economy. They're willing to take on a bit more risk for potentially better returns.
So it's like they're saying, hey, the stock market might be a bit wobbly, but I believe companies are doing well, and I'm willing to invest in their bonds.
Yeah, that's a good way to put it. And then you have short duration funds, which invest in debt securities with shorter maturities.
Right.
These are attractive to investors who are worried about rising interest rates because short duration funds tend to be less affected by those changes.
So it's like a hedging strategy. So even within the debt market, there are so many factors at play. Investors are considering their options carefully, their risk tolerance, what they think about the economy, and what they think might happen with interest rates.
It's a complex game.
Like a giant game of chess.
It really is. Understanding those pieces and how they move can help make smarter decisions.
Now, in the midst of all this market uncertainty, hybrid funds seem to be having a moment. They pulled in 6,804 crore rupees in net inflows. That's an 18.3% increase over the 3-month average. Clearly, investors are finding something appealing about these diversified strategies.
They are. Hybrid funds offer that balance of equity and debt exposure. That can be really attractive during periods of volatility because you get the potential upside of stocks with some downside protection from bonds. It's a way to potentially smooth out the ride.
A bit of a buffer.
Exactly.
Oh.
But, and there's always a but, not all hybrid funds are created equal.
Right.
In February, arbitrage funds and multi-asset funds led the way in inflows within the hybrid category, while conservative hybrid funds actually experienced minor outflows.
Interesting. What's so special about arbitrage funds? Those seem to be getting a lot of attention lately.
Well, what's cool about arbitrage funds is they aim to profit from price differences between the cash and futures markets.
Okay.
And in volatile conditions like we're seeing now, those price discrepancies, they can become more pronounced. It creates opportunities for savvy fund managers to generate returns and do it with relatively low risk.
So they're exploiting these little inefficiencies in the market to create a potentially smoother ride for investors.
Precisely. And then you have multi-asset funds. Those spread their investments across various asset classes, equity, debt, gold, even real estate. That diversification can help to mitigate risk and potentially offer more stable returns over time.
Right. Don't put all your eggs in one basket.
Exactly.
All right, so far we've covered market trends, equity funds, debt funds, and the rising popularity of hybrid funds. It's a lot to process.
It is.
But before we move on, let's zoom in on a trend that's been making headlines, the rise of SIPs.
SIPs, or systematic investment plans, yeah. They're a powerful tool for disciplined investing. And the numbers, they're impressive. In February 2025, gross SIP inflows remain strong, clocking in at 25,999 crore rupees. That's the third highest level ever recorded. Shows how committed people are to this consistent long-term approach.
It's encouraging to see that, but
Yeah.
there was a little twist in this story, right? Something about SIP cancellations.
Yeah, there was a net reduction of over 1 million SIT accounts in February, but, and this is important, a lot of those cancellations were just account reconciliations, like a bit of housekeeping to clean up the data, not necessarily a sign of declining interest.
Okay, that makes sense. So some accounts might have been closed or reconciled, but there's still a healthy influx of new investors joining this SA bandwagon.
Exactly. And even more encouraging, new SIP registrations continued to flow in, with over 4.4 million accounts added in February. The momentum is still strong.
That's great. And it's not just about the number of accounts either. The average SIP size, that also increased by 9.3% year-on-year, reaching 2,557 rupees per SIP. Suggests investors are not just dipping their toes in, they're getting more confident and increasing their contributions.
It's a sign that people are understanding the benefits of long-term investing through SIPs. That steady flow of investment, it could be a big reason why the mutual fund industry is so resilient, even when the market gets a little crazy.
Yeah, like a steady stream.
Exactly.
Okay, so we've seen how market movements and investor behavior are playing out in the mutual fund world, but how is all of this impacting the industry's overall size and composition? That's where we need to talk about AUM, right?
You got it. AUM, or assets under management, it's like the measuring stick for the mutual fund industry's health. In February 2025, the total AUM of the industry, it dipped slightly to 64.5 lakh crore rupees.
A dip. That doesn't sound so good.
Hold on. While it was down a bit from January, it's still a huge 18.3% higher than it was a year ago.
Oh, okay. That's a better way to look at it. So what caused that slight dip in AUM?
Mostly those market movements we talked about. Remember how the stock market's been down for 5 months? Well, that decline in equity valuations, that directly impacts the AUM of equity-oriented funds.
Right. It's not that people are pulling their money out. It's more about the value of their investments fluctuating with the market.
Exactly. And to highlight that, while equity AUM declined 7% month-on-month, debt AUM, that actually reached a 5+ year high.
Oh, that's quite a contrast. So even though the overall AUM dipped a bit, there's a clear shift happening within the industry. More money's going into debt, reflecting those investor preferences we talked about.
Yeah, it's fascinating. This shift in AUM composition, it can actually have broader implications for the market as a whole. It can influence interest rates, how easily companies can borrow money, even overall economic activity.
Wow, it's like everything's connected, like a giant web.
Exactly. Each piece influences the others, creating this complex and fascinating ecosystem.
So we've talked about AUM, which tells us about the size of the pie. But what about the number of slices in that pie? That's where folio growth comes in, right?
Absolutely. Folio growth tells us how many individual investor accounts are participating in the mutual fund market. And in February 2025, total folios in the industry, they hit a new record high, 23.23 crore. That's up 33.3% year-on-year.
That's a big jump. Clearly, the reach of mutual funds is expanding. It's not just for the wealthy or experienced investors anymore.
That's a great point. More and more everyday people are realizing the potential of mutual funds to grow their wealth.
Yeah, so people are becoming more aware of the power of investing, and they're not shying away from taking that first step.
It's great to see. And it's particularly noticeable in equity folios, which crossed 16.26 crore in February. More investors seem willing to embrace a little risk to chase those potentially higher returns.
Yeah, they're like, I get it, the market goes up and down, but I'm in for the long haul.
That's a healthy attitude to have when it comes to investing.
It is. All right, before we wrap up this first part of our deep dive, let's take a quick look at one more interesting aspect. AUM per folio. It's like taking the temperature of individual investors, seeing how much they're putting into their mutual fund portfolios on average.
It's a good way to gauge investor behavior and preferences. In February 2025, the industry's AUM per folio stood at 2.78 lakh rupees.
That's a decent chunk of change. But is that high or low? How does that compare?
Well, it's actually down 5.3% from the previous month and 11.3% year-on-year.
Oh, so are investors pulling back, becoming more cautious with their contributions?
Not necessarily. Remember, the overall AUM is still up year on year and folio growth is strong. This decline in AUM per folio, it could just reflect new investors entering the market with smaller initial investments, like a dilution effect. More players are joining the game, but some are starting with smaller positions.
Makes sense. So the pie is getting bigger, but the individual slices might be getting a little smaller as more people join in.
That's a great way to put it. And it's not a bad thing. It could be a sign of a healthy, growing market. Individuals from diverse backgrounds, they're participating in the wealth-building opportunities presented by mutual funds.
Yeah, it's like opening the doors wider, welcoming more people to the party. Now, let's break this down a little further. Let's see what's happening with AUM portfolio within specific categories.
All right, let's dig in.
First up, equity funds. Their AUM portfolio came in at 1.69 lakh rupees, down 8.1% from January and down 12.4% year on year. So this aligns with what we've been talking about, right? More people investing in equities, but they might be starting with smaller initial investments.
It makes sense. The equity market can seem intimidating to newcomers. Starting small allows them to test the waters, build their confidence.
Dip their toes in.
Exactly.
Okay, how about debt funds? Are we seeing a similar pattern there?
Actually, debt funds went the opposite way. Their AUM portfolio actually climbed to 24.17 lakh rupees. That's the second highest level in over 2 years.
Wow, that's a big jump. What's driving that?
This could be influenced by larger institutional investors like pension funds, insurance companies. They might be allocating more capital to debt instruments, seeking that relative stability and income potential, especially in a volatile market.
So while individuals might be dipping their toes into equities with smaller amounts, the big players are making waves in the debt arena.
Yeah, it's an interesting interplay of different investor profiles and strategies.
It is. All right, we've covered a lot of ground in this first part of our deep dive, but there's still more to uncover.
There is. We've just scratched the surface of the February 2025 Mutual Fund Industry Update.
Stay tuned as we continue to unpack the trends, the insights, and what it all means for your own investment strategy. Welcome back to our deep dives into the February 2025 Mutual Fund Industry Update. We're picking up where we left off, exploring this whole idea of AUM portfolio. You can think of it as like the average ticket size.
Yeah, it's a good way to look at it.
Gives you a sense of how much, on average, people are putting into different types of funds. We just talked about how debt funds saw a pretty big jump in their average ticket size, while equity funds experienced a decline. What about hybrid funds? Are they following the debt trend or the equity trend?
Well, they kind of landed somewhere in the middle. Their portfolio size came in at 5.496 lakh rupees. It's down a bit from January, but still up a tad compared to last year.
So it's kind of a mix then.
Yeah, seems like it. Could be that while new investors might be entering the hybrid space, those who already have money in there are sticking around, maybe even adding to their positions.
Right, so it's a mix of the newcomers and the veterans, everyone finding their comfort zone in this world of balanced investing.
Okay, makes sense. And let's not forget about solution-oriented funds, those funds designed for specific goals like retirement, saving for your kids' education, things like that. How are they doing in the ticket size department?
Solution-oriented schemes, those saw an average ticket size of 79,881 rupees, down a little from January, but still up compared to a year ago. So people are still prioritizing those long-term goals.
It seems that way. They're steadily investing towards them. It's good to see that awareness of financial planning, and starting early, it's growing.
Yeah, like they're building that foundation brick by brick. Okay, let's explore some other investment options like ETFs, index funds, and for those more adventurous investors, overseas funds. What's happening with their ticket sizes?
All right, well, this is where we see some more interesting variations. ETFs, or exchange-traded funds, they had a portfolio size of 3.68 lakh rupees. That's actually the lowest it's been in over 2 years.
Really? So ETFs are getting more popular, more accessible? Is that why we're seeing a lower average ticket size?
Could be. ETFs offer a convenient and cost-effective way to invest in a basket of assets, so they appeal to a wider range of investors, including those who might be starting with smaller amounts.
Right, so it's like lowering the barrier to entry, getting more people involved.
Exactly.
Okay, what about index funds? Those are the ones that track specific market indices, right?
That's right. Low-cost, passive way to invest. Their portfolio size was 2.07 lakh rupees, also a multi-year low. Reflects that same trend of accessibility and wider participation.
So both ETFs and index funds are seeing those smaller average investments. What about investors who are looking beyond the domestic market? What about those overseas funds?
Overseas funds, the ones that invest in international markets, those saw an average ticket size of 1.99 lakh rupees, second highest level in over 2 years.
So those are a bit higher than ETFs and index funds.
They are. Suggests that investors with a higher risk tolerance, those with a global outlook, they're putting more money into those funds.
They're looking for opportunities beyond their own borders.
Exactly.
And what about gold? It's been on quite a run lately, right?
It has. And we see that reflected in the average ticket size for gold ETFs, which reached 81,483 rupees, highest level in over 2 years.
So with all this market volatility, people are turning to gold for that sense of security.
Seems like it. That surge in gold prices and the uncertainty in the market, it's driving investors to increase their allocation to gold.
Okay, so we've dug into AUM per folio, uncovered some interesting trends across different fund categories. Now let's zoom out a bit. Let's look at the bigger picture, those forces that are shaping the mutual fund landscape as a whole.
All right, sounds good.
We've talked about market movements, investor behavior, fund flows, AUM. But to really understand what's going on, we need to consider the things that are shaping the industry itself. The rules of the game, if you will.
Makes sense.
And one of the most important factors is the regulatory framework set by SEBI, the Securities and Exchange Board of India. They're like the referees, right? Making sure everything's fair, transparent, and investors are protected.
That's a good way to put it. SEBI plays a huge role in shaping the industry, always working to enhance market integrity, build that investor confidence.
So what kind of impact are their regulations having?
Well, recent regulations have focused on a few key things: strengthening risk management practices, improving disclosure standards, and promoting investor education.
So basically leveling the playing field, making sure everyone plays by the rules, and that investors have the information they need.
Exactly. And it's leading to a more transparent, investor-friendly environment. We're seeing more emphasis on investor awareness, simplified fees, a push for more ethical practices across the industry.
That's great for investors, makes the whole process more trustworthy. Now, apart from the regulators, what else is shaping the mutual fund world?
Competition. The mutual fund industry is getting more and more competitive, with more players vying for investor attention.
So more options for investors. That's usually a good thing, right?
It is. This competition is benefiting investors in several ways. Wider range of fund options, lower fees, better customer service. Companies are constantly trying to find new ways to stand out from the crowd, attract investors.
So they have to keep upping their game. All right, let's talk about technology. It's changing everything these days, and the mutual fund world is no exception. How is technology impacting the way we invest?
Oh, technology is playing a huge role. We're seeing robo-advisors popping up, online platforms, mobile apps. They're making investing more accessible, convenient, user-friendly, more than ever before.
It's like having a personal financial advisor right in your pocket.
Pretty much. These digital platforms streamline the entire process. Real-time portfolio tracking, personalized recommendations. They're removing the complexity and making investing easier for everyone, whether you're a seasoned pro or just starting out.
Yeah, taking some of the mystery out of it. So with all these changes happening, what does the future hold for the mutual fund industry? Where do we go from here?
I think the future's bright. We're likely to see continued growth fueled by things like rising incomes, more awareness about financial planning, and growing demand for diverse investment options.
So even with all the market ups and downs, there's still optimism about the long-term prospects of the industry.
Absolutely. And that growth will be driven by innovation, shaped by technology, and the evolving needs of investors. I think we'll see more personalized investment solutions, a greater focus on sustainability, a seamless integration of technology in every step of the way.
It's an exciting time to be involved in the mutual fund world, both as an investor and an observer. It's constantly changing, adapting to new challenges, new opportunities, trying to keep up with the diverse needs of investors.
You said it.
All right, so we've covered a lot in this part of our deep dive. Explored the regulatory landscape, the competitive environment, and the impact of technology. But we're not done yet. There's one crucial question we need to address.
And what's that?
Well, we've talked about the big picture of macro trends, but in the end, it all comes down to the individual investor, right? What does all this mean for you, the listener, and your own financial decisions? That's the takeaway we want to leave you with.
That's a great point. We've analyzed the data, talked about the trends, but how can people use this information to make smarter choices? How can they apply it to their own financial journey? That's what we'll explore in the final part of our deep dive.
Welcome back. It's the final stretch of our deep dive into the February 2025 Mutual Fund Industry Update.
We've covered a lot of ground, haven't we? From those market swings and how investors are feeling to the rise of different types of funds and what those SEBI regulations are doing.
We've seen how this whole mutual fund landscape is constantly shifting. But now let's make it personal. What does this all mean for you, the listener, for your own investments?
That's the big question, right? And while there's no one-size-fits-all answer, no magic formula, the things we've learned, they can offer some valuable guidance.
Okay, so let's get practical. We talked about market volatility being a natural part of the investment cycle. But I think for someone who's new to this, or even someone who's been doing it for a while, those ups and downs, they can be a little unnerving.
Oh, absolutely. It's like riding a roller coaster. Thrilling for some, terrifying for others. But the key is remembering, investing, it's a long game. Don't let those short-term swings throw you off course. Think long-term goals.
So don't freak out when the market dips. Maybe see it as an opportunity.
Exactly. When prices drop, it's like a sale at your favorite store. You get to buy those quality assets at a discount. Time in the market, that's often better than trying to time the market.
Right. Consistency, discipline, not trying to predict the future.
Yeah.
Now, we also saw how certain types of funds, like sector or thematic funds, flexicap, arbitrage, those are becoming more popular. Should investors be jumping on those bandwagons?
Well, not necessarily jumping on bandwagons, but definitely worth exploring them, seeing if they fit with your own investment style, your goals.
So it's like shopping for clothes. You wouldn't buy the first thing you see. You got to try things on, see what fits, what's in your budget.
That's a good way to think about it. Research those fund categories, see what their strategies are, the risks, potential returns. Do you believe in renewable energy long term? Are you interested in the flexibility of flexicap funds? Or maybe you're after that relative stability of arbitrage funds. Find the right fit for you.
And that brings us back to SIPs. We've talked about how they embody that disciplined approach to investing. But is this something everyone should be doing?
SIPs are a really solid tool for building wealth over time, especially if you prefer a more hands-off approach or you're just starting out. Investing a fixed amount regularly, you average out your purchase price, helps smooth out those market bumps.
It's like setting up an automatic savings plan, but for investments.
Exactly. You're putting money aside consistently, little by little, without having to stress about it too much.
And speaking of starting out, we've seen that more people are dipping their toes into the mutual fund market. What advice would you give someone who's brand new to all this?
First off, welcome. It's great to see more people taking control of their finances. For those just starting, the most important thing is figure out your goals. What are you saving for? Retirement, down payment on a house, your kids' education. Once you have a clear destination, then you can map out a route. Choose investments that match your goals and your timeline.
So it's like planning a road trip. You need to know where you're going before you can pick the best route, the right vehicle.
Exactly. And don't forget diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes, equities, debt, gold. Think about diversifying geographically too, both within India and internationally. Helps to manage that risk, potentially build a more stable portfolio.
It's like building a balanced meal. You need all those different nutrients to stay healthy. Okay, we've talked a lot about choosing investments, but what about managing them once you've made those choices? Is it a set it and forget it kind of thing?
Not at all. Managing your investments is just as important as picking them. It's an ongoing thing. You need to check in on your portfolio regularly, see how it's doing, and make adjustments as needed.
Like tending a garden. Can't just plant the seeds and walk away. Got to water them, prune them, make sure they're getting what they need to grow.
Perfect analogy. Stay informed about what's going on in the market, the economy. Rebalance your portfolio every now and then to keep that asset allocation where you want it. And don't be afraid to ask for help from a professional if you need it.
Right. Everyone's garden is different, and everyone's financial goals are different. So we've covered so much in this deep dive. We've really thrown a lot of information out there. As we wrap things up, what's the one key takeaway you want our listeners to remember as they navigate their own financial journeys?
Invest in your financial literacy. The more you understand about markets, investments, personal finance, the more confident you'll be making those decisions. There's so much information out there, books, articles, podcasts like this one. Keep learning, stay curious, never stop asking questions.
It's like sharpening your tools, getting yourself ready to be a more successful investor. And remember, investing, it's a journey, not a destination.
Well said. Be patient, be consistent, and keep those long-term goals in sight. And most importantly, enjoy the ride.
Great advice. So that wraps up our deep dive into the February 2025 Mutual Fund Industry Update. We hope you learned something new, discovered some new possibilities, and feel ready to take charge of your financial future.
It's been a pleasure diving deep with you.
And to everyone listening, thank you for joining us. Until next time, happy investing.